Today, a former Deutsche Bank employee pleads guilty to crypto fraud. Grayscale files for a new Ether futures ETF. And Brian Mosoff, the CEO of Ether Capital, breaks down the factors that could lead to Ether's next prolonged rally. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Major cryptocurrencies dropping slightly today, but as of noon Eastern, Bitcoin still traded above the $27,000 level. Ether dipped more than 1.5%, trading below $16.50. Solana, however, rose to $20.19. Okay, let's talk about the top stories. A former Deutsche Bank investment banker pleaded guilty yesterday to a crypto investment fraud scheme. According to federal prosecutors, Rashawn Russell misappropriated funds between November 2020 and August 2022 from investors that he enticed with promises of big returns from crypto trading. Russell then used the funds for his own personal benefit to gamble and to repay earlier investors. The U.S. Attorney's Office for the Eastern District of New York said that more than 29 investors lost at least $1.5 million through his, quote, scheme. As part of Russell's plea agreement, he'll have to repay those funds. Next, Stanford University will return all of the gifts that it received from the now bankrupt crypto exchange FTX. That's according to Bloomberg, which cited an emailed statement from a university spokesperson who noted that Stanford has been in discussions with attorneys for the FTX debtors to recover the gifts and will be returning the funds in their entirety. Now, this follows a lawsuit against the parents of Sam Bankman-Fried filed this week, which alleges that the university received millions of dollars in FTX group donations. SBF's parents, Joseph Bankman and Barbara Fried, are both Stanford law professors and, according to this court document filed on Monday, allegedly funneled millions of dollars from the company to, quote, enrich themselves. We reached out to Stanford University but didn't hear back right away. Last up, Grayscale has filed to launch a new Ether futures ETF after it abandoned plans for a similar fund back in May at the height of the SEC crackdown on crypto. The move follows a wave of other applications from asset managers for ETFs that track Ether futures, according to the Wall Street Journal, which added that an Ether futures ETF has yet to be approved. Last month, Grayscale won its lawsuit against the SEC in regards to its spot Bitcoin ETF application. Now, Grayscale also offers an Ethereum trust investment vehicle. All right, sticking with Ether for our main story, a new upgrade for Ethereum's network hopes to slow down the pace of staking and avoid a surge in gas fees. Crypto World's Jordan Smith asked Brian Mosoff of Ether Capital to explain how that upgrade will work. They also spoke about the factors that could drive Ether's next long-term rally.
So there's this new Ethereum improvement proposal. It's EIP 7514. It looks to slow the maximum growth rate, or the growth rate of maximum validators on the network. Can you walk me through why this change is being proposed? What problem is out there that it's looking to solve?
So proof of stake is still relatively new to Ethereum. Even though it's been a couple years since POS first went live, it's still been relatively new that we're seeing a lot of people want to participate in this activity. And what we've noticed over the last year is that there's a large number of validators coming online. They enter the queue, and that entry queue, that buffer, that waiting period before the validators come online has been so big that it may be over a month long. Now, what this means is it's very difficult to predict what the yield is going to be on Ethereum. If you're currently a validator, your ETH is locked during the period from when you spin up a validator and enter that queue. You can't exit. There's no way to say, forget it, I'm tapping out. And so long-term, the goal of Ethereum is to create a base layer that's predictable, that everyone knows what the yield is going to be, and have a place where all the activity knows what the network security is going to look like. And so this new proposal is about smoothing that out. It's about building predictability into the network, where right now, with the amount of validators coming online, the amount of Ether being deployed into staking, there's this theoretical, the amount of circulating supply is going to cross well above 50% that gets locked into staking, and that makes gas fees difficult to predict. Because if there's less circulating supply, it's harder to know, well, how much you're going to have to pay for certain activity on the network, because you're going to have to, buy up very scarce amount of ETH. And so what we're trying to do here is buy time and build in that predictability. And that's what this is all about.
So how would this work in practice? And is this the only way to sort of slow down the pace of staking and avoid some of those issues that come with too much ETH locked at one time?
I think that the amount of ETH getting deployed into staking is slowing down naturally. You've seen the yield come down. It was well above 5% when proof of stake went live and the merge first took place, which is all of that activity moving from the proof of work chain to the proof of stake network. And now what you're seeing is that activation queue, the timeline from when you deploy your staked ETH or your ETH into staking, that's gone from as high as 40 days down to just above 10. And so what that tells me is as that yield comes down, and it's currently just above 3.5% for the consensus layer, what that's telling me is that less people are finding staking attractive. So we're finding an equilibrium here. And the goal, though, is to make this even more predictable, to say who really wants to perform this activity, who wants to lock up their ETH and provide out this infrastructure to the network, to provide that network security, and what will that long-term yield be? So we already are seeing the amount of ETH deployed slow down, but it's still not predictable. There's still no ceiling on how much ETH can enter that queue every day. At any point in time, someone can click a button and deploy a large number of validators. I mean, they have to have the ETH to do it. But what this means is people are going to have to plan ahead. People who are staking providers are going to have more guarantees around what they can earn. And that's good.
I want to pivot to checking in on the ecosystem as a whole. I mean, you mentioned the merge earlier, and we just hit the 1-year anniversary of that upgrade on last Friday. And I just want to ask you about that upgrade over the past 12 months. It was largely dubbed a success from an environmental impact perspective, from an efficiency perspective. But are there any other big lessons or takeaways over the past 12 months since that transition to proof of stake?
I think everyone thinks that the merge was a success. Where the ecosystem has evolved since then is we're seeing a lot of activity move on to Ethereum layer 2s. You're seeing bridges between other layer 1 networks start to turn into rollups on Ethereum. And the world is kind of merging together where there are these narratives around a multi-chain universe versus ETH with these layer 2s. And it's all kind of coming into, you're going to be able to move your asset between any of these chains, whether it's Ethereum natively, with this kind of vertical stack up to a layer 2, or it's on a different network. It's really just going to be about where is the activity appropriately priced, what has the infrastructure for the specific type of transaction that you're trying to perform. And so the ecosystem's evolving. It's figuring out how do you build scalability in, and it's not just going to be up to Ethereum at the base layer. It's going to be whatever network or architecture makes the most sense. That's fantastic from an institutional standpoint. I imagine we're going to start to see private layer 2s begin to emerge. Again, companies like Visa who are looking around and saying, ETH layer 2 or Solana may be appropriate, and they'll figure out how to settle up between the two different networks. And so the ecosystem's evolving. It's maturing, and long term, we just want to have more and more of these blockchains plugging in to being able to talk to one another. More activity moving on chain, more tokenization of real world assets moving into this ecosystem. It's time for the institutions who have been either on the sidelines or beginning to do very thoughtful research to start spinning up their own tech and saying, how are we going to tokenize activities that we have inside of our traditional financial infrastructure? How do we leverage this technology and these networks? And can we move some of that stuff on chain? And I think the answer is yes. And now it's really about just scalability, building out that infrastructure, and having clarity from a regulatory standpoint. And that includes staking clarity. A recent paper that was put out by IOSCO that talked about DeFi, that covered what the staking providers and their relationships might be to retail or the custodians, how MEV relayers, how the transaction fees are processed. There hasn't really been clarity around, are these registerable activities or not, and what the appropriate relationships should look like between all of these different entities. But we're getting there as we move in through the rest of 2023 and into 2024, and the US spot ETFs come to market. I think it's a really exciting time for the space.
I want to finish the conversation on Ether, specifically around price. I mean, we had this run up earlier this year. We sort of came off the FTX banking crisis lows. We've rebounded, but now we're stuck in this range right now. And on Crypto World, we've explored the catalysts that will sort of start the next Bitcoin bull run. But I want to ask you if there are any catalysts for Ether that can help drive that price any meaningfully higher for a long period of time versus these maybe short bursts that we've seen in recent weeks.
Well, there's certainly a lot of excitement right now around all of the US Bitcoin ETFs that are pending approval from the SEC. I think people expect that those will be greenlit somewhere within the next month to 6 months. Whether it takes longer than that, who knows? But I think it's time for these products to come to market. So we know why people are going to be excited around Bitcoin. ETH and the rest of the market is going to follow that move. Now, once there's a path to a spot ETF for Bitcoin, you would assume that a spot Ether ETF will also come to market. Now, whether you're able to stake inside that ETF or that takes more time, who knows? But that is certainly going to be a catalyst. The market has moved past the FTX era, and you're seeing the institutions that went pens down around the FTX and the Three Arrows Capital and the Voyager collapse. They're starting to come back to the space, and the primitives around why Bitcoin and why crypto and digital assets and settlement layers, that never changed. So despite the outside perception of the price being very volatile and a pretty hard 2022 in just the asset pricing, that's fine. People need to shift their attention to long-term, these networks are going to continue to exist. They're very important, Bitcoin specifically around being a check basically on just central banking policy, and Ethereum acting as this politically neutral settlement layer for all sorts of activity. So as attention turns back towards the space, I think both Bitcoin and ETH will catch a bid either later in this year or early next. But the inflection point, I really do think is going to be these spot ETFs followed by the Bitcoin halving next year and just more activity moving on chain.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, and we'll see you then.